Let's do a quick market review with everything that you need to know about the stock market right now. And of course, all our research comes from MacroOps, our global macro research and consulting firm. So there's two competing truths in this market right now. One is that we have trend fragility, the same thing we've been talking about for months now. If you've been watching our videos, you already know. So retail and fund managers are at or near multi-year highs in levels of risk taking, but breadth versus price divergences are at historical extremes. And you know, in a healthy market, you want strong breadth, meaning all the stocks are moving together, not just a few of the big stocks pulling the indexes up while most of the stocks are falling or going sideways. So bad breadth is usually a sign that the market will likely turn around, even if the price is going higher right now. Now, the second thing we're seeing in the market is that consensus growth expectations are still too bearish. So these growth expectations need to be re-rated. And this is actually good for the market because there's a very low hurdle for all these stocks. So that creates a constant upward revising of expectations, meaning positive surprises. And that creates a strong bullish tailwind. Because you know markets are all about expectations. So say an earnings report is coming up for a company and everyone is expecting the company to lose 2 cents. Well, if they only lose 1 cent, you're going to see that stock price shoot higher because even though the company is still losing money, they still beat expectations. So what we're saying here, when growth expectations are too bearish, that creates a low hurdle, meaning it's easy for these companies to surpass the expectations that investors have of them. And whenever that happens, again, stock price shoots up. So let's talk about breadth again, like we do every week. So short-term market breadth remains at its widest diversion from the tape since the weeks preceding the February 2020 top. So very bad breadth compared to price. Price goes up, breadth goes down. But it looks like it may be starting to turn up and converge with price. But every day it doesn't, the odds rise that we're nearing a more significant market top. Because again, this is more like a leading indicator. You can see down here, this is breadth. The SPX is currently in its 10th percentile of trend durations without a 10% correction. So we're overdue for one. So you can see right here, the last time we saw breadth diverge like this with price going up and breadth going down, this was right before the COVID bear market. So breadth needs to turn around here to confirm these higher prices. Otherwise, there you go, bearish signal. We also see that credit spreads are beginning to widen. And when they widen like this, it either means that we're at the bottom of a correction or a top that precedes an even larger correction. So you can see this down here, this red line, a rise above the 20 mark, which is the red dotted line, without a corresponding drop in the market would be reason for caution. So again, credit spreads widening while the tape makes new highs. So prices hitting new highs. So continuation of this trend would almost certainly precede risk off, meaning the market would fall. For the bull to continue, we want to see spreads settle down a bit. And semiconductors, while they're on the cusp of breaking out from their extended trading range, which again we've talked about in previous videos, the breadth is still not confirming the bullish impulse that we're seeing. So that's the moral of the story. You want breadth and price to work together. An upwards breakout combined with a decline in breadth below the 70% level, which is this red dotted line again, that would suggest that the market is putting in a large bull trap. So if they break out to new highs but then breadth falls below this line, that means bull trap, meaning all those people that bought in are likely going to get stopped out. It's a fake out in the market. We got the same picture with the New York Stock Exchange, but here it looks like the breadth might be strengthening again, but from weak levels. So one question that we have is breadth so bad that it's actually good? So the market may have survived a test wringing out the weaker positioning, which we'll talk about more in a second. But the way you got to think about market breadth is like an advancing military force. Strong breadth is similar to an army with a deep and disciplined line. So this is the old school battle that we're talking about when fighters stood shoulder to shoulder. And that line has strength and weight behind it. It can move forward and push through barriers. But on the other hand is when the line is thin and begins to fracture. It doesn't take much from an opposing force to break it completely. And that's how major trend changes happen. Each issue in an index is equivalent to a soldier standing on that line. And it's always great hearing military references from Alex because if you don't know, he is a former sniper from the military, special forces. If you've seen American Sniper, that was his life, which is pretty nuts. But not as crazy as his life is now, you know, sitting in front of a computer and doing market research. But of course, anyone would prefer that over getting shot at. So yeah. Anyway, the bull case here is that breadth is so bad that it might be good. The idea is that despite the weak breadth in the market, the indexes have held their own. And the hope is that the oversold weaklings will revert to their stronger peers and join them back in the front lines. So basically the market might look so strong that breadth doesn't matter. And in this case, breadth might be a lagging indicator because all these other stocks just need to turn around and follow the leaders. Doesn't normally work like that, but so far this has been happening for months, right? So that might be the case here. And you remember we did a study on this by backtesting what prior instances in the Russell look like when the Russell was above its 200-day moving average and breadth was this poor. So out of 22 instances, 68% saw positive returns over the following 20 trading days with an average return of 7.25%, which is quite significant, obviously. But a key difference though is that in past instances when we've seen this is that the weak breadth was just kind of isolated to the Russell, while the other major indices showed greater strength than they do now. So the difference now is that all the indices indices are showing weak breath. So it may not actually apply here. Now, as for the bullish case, the size and consistency of the revenue and earnings beats that we've seen over the last 5 quarters are examples of the too bearish or not bullish enough anchoring by analysts and investors. And this is what we're talking about, right? Their expectations are too low, which makes it easy for these companies to beat them. This low hurdle that they've created is a positive tailwind for risk assets. Because again, every time they beat expectations, you're going to see that price pop. Now, considering that the global economy has yet to fully normalize due to the Delta variant and the slow vaccine rollout globally, and the many supply bottlenecks crimping demand, which don't affect me anymore because I got my PS5. But considering that it's affecting everyone else, we have still yet to see the full impact of the historic levels of global stimulus that's been juiced into the system. Not to mention the credit multiplier from repaired balance sheets, higher home prices, and 12 plus months of pent-up demand. So things are better in the economy, but they're going to get even better. We've got CapEx intentions, which is companies reinvesting at record levels, and corporate buybacks regaining pace. And if you remember, corporate buybacks are key to our bull market. That's a lot of buying pressure. So we're set to see well above trend growth for the next 1 to 3 years, which is why we're long-term bulls, barring another catastrophic external shock. So if that COVID thing mutates, then yeah, that would suck. Our growth composite model at MacroOps is coming off its highest reading in over 40 years. And while the delta of growth will be lower, the absolute number will remain well above average. So delta was what? The change in growth, right? So how fast is it accelerating? It'll be lower, but the actual number is still above average. And the higher growth is helping to repair US valuations and should continue to do so as long as the market underweights incoming growth. Now, eventually, higher growth will lead to a steeper yield curve, which yields really affect this price of stocks. But the big question is, does that start now, or do yields have one more leg lower, driven by a correction in risk assets and a reset of current trend fragility? Well, we don't know, but you can always follow the price, right? That's the simplest way to do it. So remember, there's a few things that we want to keep an eye on. First being credit spreads. If they continue to widen from here, then we'll know that any broader bull action in the market will be short-lived, because those two need to confirm. Second, if semiconductor breadth doesn't soon turn up and confirm price, we're going to want to start getting more defensive. That's another leading signal right there. And third, if the Russell dips below its 200-day moving average, then that'll be a sign that the bear trap pictured below was not a trap at all. So you can see right here how it dipped below and sprung up. That's a bear trap. So everyone who tried to short got screwed. But if it goes back and breaks the 200 level, well, then it's a very bearish sign. Now we can look at the charts a little more closely here because it is the beginning of the month. So we got another monthly print. And monthly charts are great because there's a lot less noise in them. When you pull back in time frame, the noise to signal levels falls further and further the wider you go. So it makes it much easier to see where the large supply and demand imbalances, aka the trends, are. So you always want to be able to zoom out. So the first of the month is fun. So you can see right here the SPX is reaching the apex of its 16-month rising wedge, and recently it formed 6 consecutive bull candles, which is quite rare. You can see right here 1, 2, 3, 4, 5, 6, and this is the longest bull streak in 10 years. And that means that the long-term trend is strong, and the odds are high that we see a multi-month pullback consolidation after the next few months, because what we're probably going to see here is this red line. We're going to peak above this rising wedge, have that buy climax, and then get the pullback and consolidation for 1 to 3 months. And that's the whole buy climax scenario that we've talked about many times before. So again, the bullish impulse is strong and long-term demand clearly outstrips supply. So that's why we're long-term bulls. But historically, we do begin to see profit taking around these levels, meaning a 1 to 3 month price correction, which is this red line, right? So because we saw a fairly strong close for July, we'll probably see that market pitch over the top of its wedge before correcting. You can see July here, that's a pretty nice bar. It's a bullish bar. And since the bulls have been so strong, like these 6 bars that we've seen, the bullish ones in a row, we should expect that any correction will get bought and thus be relatively short-lived, meaning 1 to 3 months. Now moving on to small caps with the Russell, the bulls were able to come in and save them from putting in a bearish close for July. So you can see this is a bearish bar in a sense, but this wick is super long. It's actually bigger than the body, meaning there is strong support here. Bulls come back in and buy it. So the consolidation, which has been happening for 6 months now, it continues. Like it says here, the long lower tails on the monthly candles within this consolidation, because it's actually not just this July bar, it's all these bars that have those long tails, means there is that strong willingness from buyers to come in around the 2200 level. And the consolidation makes sense considering this crazy bull run that we had. This is not out of the ordinary. We hit extreme levels of overbought, and buyers don't usually like to buy too far away from the averages, which is why we have mean reversion. Markets only do 2 things. They trend and they mean revert. Right now, we are in the mean reversion stage after a strong trending phase. Now, historically, when the Russell rises 20% above its 20-month moving average, it takes an average of 9 months before the index hits new highs again. So we just finished month 6 of our consolidation position in the Russell. So we may be near the tail end. And this is showing that 20% extension right here, this red line. So again, it takes 9 months on average for that to work out. Now you guys know Bitcoin and crypto has been back in the news, so let's take a look at them. And according to Alex, Bitcoin and Ethereum have probably the 2 most compelling monthly charts right now of any asset. Why? Because they've completed their 3-month correction following a strong 6 consecutive bar bullish impulse. So again, we see this big trend right here and then the consolidation. So this shows there is strong demand. But then we had 3 months of profit taking and mean reversion, which again, normal. But just like in the other chart, the large lower wicks show strong buying pressure around the 30,000 area. Like we were saying in previous videos, if Bitcoin was going to fall apart, it would have already. It would have broken past this 30,000 level, but instead it rebounded. So you can see July's bar right here, the white one, because it's so bullish looking and it closed near the top, it means that this correction is likely over. So the correction has worked off Bitcoin's technical overextension and now it's poised for the next leg up. So it might be a good buying opportunity right here. In the macro ops portfolio, we have a 5% position in the Grayscale Ethereum Trust, ETHE. And we'll actually add to this if we get an entry point. So the market isn't super clear right now, but we always have price to guide us. And of course, we'll continue to do these weekly market reviews to see what changes are coming through. But if you want to make your life a lot easier, then definitely just check out our system. We have a free training that shows you exactly how to use our Fallible system, how it works, everything. Same thing I use and all our Fallible members use. I'll put a link to it in this video and down below in the description and comments. Nice thing about a system, you don't need any research once it's built. All you got to do is execute on the system, and that's what I love about it. Now, of course, psychology still comes into play, but you don't have to figure out macro. So again, to check that out, just click this link right here, and I will see you in that training.